Hey folks, Dan Frio here, the Mortgage Update. Today is September 16th, 2020. Look folks, I'm not flicking you off. It's my ring finger. I got rid of my big bandages. My son was like, hey, when are you getting that off of there? So thanks, Marcus. And I appreciate your input because he usually critiques my videos every day. So that being said, what happened to rates today? Well, the Federal Reserve came out and said, you know what? We're going to do, stay tuned. I'm going to tell you that in a second. Don't go away. The Fed news today. Well, there's the saying that you trade on rumors, or you buy on the rumor, sell on the news. What that means is there's usually a lot of hype involved when things are proposed, like somebody's earnings are going to come out, or something like that. So you buy the stock. Then as soon as the earnings come in or they get announced, even if they blow out the quarter, many times the people have already bought the stock and the trade's in, and then the stock drops, and you're like, what happened? They came in with robust earnings. Well, yeah, because everybody bought on the rumor and sold on the news. And so that's what we're kind of seeing a little bit today, but we didn't sell off. That's the good news is. But the Fed came in and said they're really not going to do anything for the foreseeable future, and probably not until like 2023. Now, let's take that with a grain of salt, and let me go over my thoughts behind a lot of this. And I'm going to show you something here about what I'm talking about. So the Fed came out and said, we're really not going to change any of our policies. We're going to keep stimulating the economy. We're going to keep buying, mortgage-backed securities. We're going to continue to buy treasuries to keep rates low and everything else. And what they're saying is, we're going to watch inflation, but our biggest factor right now is the unemployment rate. And we're going to see, here's the projections that they see, and here's why they're saying they don't expect to do anything until 2023. So they expect the unemployment rates for 2020 to be 7.6, dropping to 5.5 in 2021, 4.6 to 2022, and down to 4 at 2023. I think they're looking at a factor. They want to be at like 3 or 4% unemployment. And then they're saying the projected inflation is going to be 1.5 this year, 1.7 next year, 1.8 the following year, and then 2, their benchmark in 2023. Okay, so here's my, what do I want to say? Here's my take on it. And take it for what it's worth. I've done this a long time, and I've traded stocks, and I've been in the mortgage business, and I'm even a dad that wants to swim on the weekends. Wednesday, it's showing that Sunday's going to be beautiful. Come Sunday, it rains. What I'm getting at is we don't know what's going to happen 4 or 5 days from now. How in the world do we know what's going to take place 3 to 4 years down the road? So here's my problem with this whole analysis that they came out with. Let's assume, just for amuse me, let's assume that we have a V-shaped recovery, meaning as soon as the markets open back up, businesses, restaurants, services, the whole ball of wax. And as soon as we come out with a vaccine, it's probably going to alleviate a lot of things. And mark my words, as soon as the election is over, we're also probably going to see some miraculous things happen. And I don't care who gets voted in, but every election year, there's a lot of stirring up of emotions in different areas. So that being said, let's assume, just to amuse me, let's assume we have a V-shaped recovery, and the vaccine comes out by the end of the year. So next year, everybody starts going back to work. The unemployment rate starts to drop. People start buying. People are comfortable. They're like, you know what? I lived through that catastrophic time. Now I'm going to enjoy life a little bit more because life wasn't so bad. We thought it was really bad until we hit this pandemic. It's like people that have, they found out they had cancer. Then they get cured. Their whole outlook in life is different. They're like, you know what? I'm going to enjoy life a little bit more. So let's just say that happens next year and people go back to work And now they're like, you know what? We're going to go out to dinner some more. I'm going to fix up my house. I'm going to enjoy a little bit more on the relevant things. Okay, so let's just hypothetically say we have a V-shaped recovery, meaning we recover faster than what their projections are from the Fed. Well, also, we've pumped in gazillions of money into the system, causing, or it's going to cause, inflation. I don't think if we have that V-shaped recovery, it's going to take 3 years for inflation to rear its ugly head. So I got a little bit of a problem with this, but I hope I'm wrong, but I don't think I am. But that being said, I don't think things are going to be catastrophic. The housing market is strong. Rates are historically low. Even if rates went up a little bit, even if they're at 2.99 now and they go to 4 or 5, it's going to increase the average payment $100. Are you not going to buy that house because it's extra $100 a month? No, you're probably going to buy it. And there's pent-up demand for homes. Okay, so that's my take on all of that part. So now let's get on to what happened with rates and where I see them going in the next couple days, months, and let's say years. So let's get into it. So here's the chart of today. Again, we had a lot of, there wasn't a lot of flexibility or flux in the numbers for the last week or two, and thank goodness for the Fed. But again, they're stabilizing this market. So today's news that came out was already baked in. There was no news out today that was like, whoa, that's a shocker. So because of that, we stayed stable. And as you could see up here, it didn't affect the market at all. Nothing changed today. Normally, if the Fed came out and announced, you know what, we're going to keep the rates low for years, this number would be way up, driving down rates. And it didn't, because it's already baked in. So that's what's going on with the market. Here's what I see. I see stability in the markets right now. You also saw the Dow really didn't move today. So the Fed picks its side of an inflation debate and sends the market message, no rate hike for years. What did the Dow do? Hold on, let's see. Markets. I got another thing that I can go to here. Let's go back to here. The Dow was up 36. No major move. Bond prices, no move. Things are settling down. The good news is the fear. This means basically there's less fear in the markets. Everybody's like, okay, we know what the Fed's going to do. The economy's starting to recover a little bit better. And then all this other stuff. So there's no surprises in the market. That's what we want. That's what we like. So what do I expect for the rest of the week? Really nothing. The economic calendar we had, if you go through a lot of this stuff, retail sales, it was down. Actually, a pretty big down cycle, but you take out sales ex auto, not as big a move. But then you say let's see, housing market index. Housing's just, it's doing fantastic right now. And I am not predicting a bubble. Now, what could change that? I'll tell you what can change that is if people don't get back to work fairly quick. If there is no stimulus plan approved by the government, which I think we're going to have one really soon, because I think a lot of people are finally getting it, saying if we don't put in some more stimulus into this economy, we're going to have some problems. Here's why. Our country is about 2/3 service oriented and 1/3 manufacturing. That is a big difference from where we were 20, 30, 40 years ago. The service industry, a lot of restaurants, sporting events, concerts, they're all closed. If we don't turn them on soon, the owners of those companies are really going to start to feel it, because the PPP and a lot of SBA loans and things like that have been bailing out a lot of the small companies, allowing them to give payroll out and keep their bills paid. We were paying out that $600 unemployment extra each week, plus the state benefits. That stopped. That pays a lot of those employees. A lot of the manufacturing is now back to work, but the service sector's out. That's 2/3 of our economy. If something doesn't happen soon, you might start to see people defaulting on their loans. But what I expect there is the banks aren't dumb. And they're going to work with these homeowners at this point because they lost their pants back in 2007 to 10. And I think they learned a lesson during those times. So there's going to be a lot of programs to help homeowners that might not be able to make their mortgage payments. That I can almost guarantee you that will happen if we start hitting a crash in mortgage delinquencies. And maybe tomorrow I'll look up and do a report on where we are with mortgage delinquencies. So that's where we are. That's my thought on that. But let's get back to the chart. So basically this week, I don't really see anything happening. The next couple weeks, I really don't see anything happening. Now we're getting closer to the election. As we get closer to the election, there's going to be some uncertainties. Those uncertainties is who's going to be elected. I mean, it is basically oil and water right now on the different parties. I'm not going to get into politics. You have your own 2 cents there. Either which way, there's going to be some repercussions one way or another, and we're probably going to see a little blip in that sector then, but you're talking about 2 months out. And then you're going to hit the holidays and everything else. So I really, through the end of the year, I do not see anything. So if you're looking to buy a house, buy the house. Rates are fantastic. Are they going to get better? I don't think. I think basically we hit our catastrophic point. Now, what's another piece that can throw the monkey wrench into this thing? When the flu season hits. If we have the flu season toppled on top of maybe another round of corona, that could really shock the market. But if there is nothing really catastrophic that we see in the markets, I really don't see us moving from here. We should stay in a tight range for a while. The stock market, I don't see anything really blowing up there, good or bad. We had our 5 to 10% basically correction, and people then jump back in and they're buying in different sectors there. Those sectors are relevant. You're talking about transportation, Amazon, Google, all the internet stuff, that they're actually seeing a surge because people are staying home, ordering online. Between logistics, meaning having stuff shipped, and online services, you're seeing a lot of things happening there in a good way. The market wrap, like I said, we just went over that. Economic calendar, there's really nothing that's going to shock the market here. Jobless claims, housing starts, housing permits, all that coming out in the next 2 days. No shocker there that should be really affecting us at all. So basically where I'm at right now is if you haven't locked in a rate, don't lock it in. So let me explain to you a little bit on how rates work. There's a whole bunch of factors that get involved with mortgage rates. And let's break down a couple of them. Your credit score plays a big role in your mortgage rate. What we call the loan to value, meaning the loan divided by the value of the house. The higher that is, the loan to value, the higher your rate. So meaning, here's the best way to explain it. If you got to have $100,000 owed on a $100,000 home, 100 divided by 100 is 100. If you owe $50,000 on your home and it's worth 100, 50 divided by 100 is 50. So it's 50% loan to value. The lower the loan to value, the better the rate. The next thing is the term, obviously. The longer the term that you have, the higher the rate. And believe it or not, there's 2 other things. What kind of property it is. Is it your primary home or investment property? That's another thing. And the last thing is, are you doing what we call rate and term or cashing out? So are you just refinancing your rate or your current balance to a different rate or a different term? Or are you looking to pull out cash to pay off bills? If you're pulling out cash, your rate's a little bit higher. So those are, I think, 5 factors that we just went through on those. And last but not least, when you lock a loan, what I mean by lock a loan is it's like buying a stock. So let's say you like Google stock and you're watching it and you're like, I don't know if I want to buy or not yet. That's when you're doing that in the mortgage piece. We haven't really bought the loan or stock. We haven't locked in your rate. We haven't really made that final decision yet. When we lock your rate is basically like when you like Google stock at that price, you buy it. So now it's yours. So locking in your rate also can affect or does affect your rate. Here's what I mean by that. The longer the duration of your lock, the higher the rate. So I'm going to exaggerate this a little bit, but let's say you can't close until for 90 days. Well, your rate might be 3.5%. Well, if you condense that to 60 days, it might be 3.25%. If you can do 45 days, it might be 3.125. If we can get you all the way through the system and lock you in right before you close and get a 15-day lock, you might be at 2.99. So if rates don't move at all, but we can push you along downstream and get you to the point where you're pretty much cleared to close and lock you in, might be able to get you a rate. And I exaggerate a little bit. There might be a difference of 0.2 or 0.3% if we can take you from a 90-day or a 60-day to a 15-day lock. So that's another thing to think about. And so if mortgage rates are stagnant right now, or the mortgage market is stagnant, MBSs, we might hold off and not lock you and wait all the way for 15 days and then lock you at a much better rate than you'd be today if we had to lock you on, say, a 60-day. Right now, it's taking about 60 days, believe it or not, to close on loans because we're inundated. Thanks to you guys, and we're blessed that I'm not complaining about the business because we have more business than we can handle right now, and thanks to you guys. So if you like what you see and you want to reach out to me and say, Dan, can you help me? Here's what I ask you to do. The best thing to do is if you're in the process right now of buying or refinancing a house, you have a quote already. Let's get a second opinion. Send that quote to me, okay, in the form of what we call a loan estimate or a fee worksheet. And if you're in the process of a mortgage right now, they can offer you one or both of those things. It's going to tell me your address, the value of your home, the loan amount, the cost, the fees, the term, the rate. I need that stuff. I also need what your mortgage or your credit score is. If you don't know your credit score, I have a sponsor of the show. It's creditscoresandmore.com, and it's down in the description all the way at the bottom. You can click it. It's free. Just go there, click step 1. It's a free credit score. Just tell me what that credit score comes back as. Now I have all that data. So what I'll do is I'll take that loan estimate that you gave me, and I'm going to write all over it in red pen. And it's going to say, the quote that you have right now is 3% with $4,000 in fees. Don't be surprised if I come back at 2.875 with $895 in fees. You're going to have that in red pen. What's happening most of the time is people are saying, Dan, I need that in writing. I need a quote from you. I can't do that if you don't apply for a loan. Basically, the best I can do, I don't have all your information. The best I can do is what I did. And I always tell you, I'm a man of my word. I've been doing this for 33 years. Check all my comments, my everything down below. I do the best I can. The one thing I won't lie to you. So if you have that in writing, I'll honor it as long as the data that you presented me is backed up. So if you say your house is worth $400,000, it comes back at $300,000, we got problems. I won't say problems, but that's not what I quoted you on. If you say your credit score is 800 and it comes back at 600, there's a difference there. But I promise you, I'm going to be as accurate as I can. I'm not going to say, I can get you 2.875 and no fees. Then you apply for a loan, everything matches up to what you said, and I come back and say, you know what? I'm sorry, it's 3.25 now with 5,000 in fees. I will not do that. I promise you. So please, the best way to get a hold of me to do all of this, I'll show this to you right now, is go to, let me type it in, therateupdate.com. It's not jumping in for some reason. So therateupdate.com. You can scroll down here, and this will give you the phone number and how to reach us personally. The phone number is 844-775-LOAN. That's 844-775-5626. My name is Dan Frio, DANFRIO. You can email me at dfrio@preferredrate.com. Or easier way, just get a free quote, apply for a loan, or go through one of these. If you're looking to get pre-approved to buy a home, click here and start. If you're looking to refinance and get started right away, click right there and get the ball rolling. So that is it for today. Guys, I am about 150 people shy of 10,000 subscribers. I need you to help me, please. That's all I ask. So please give me a thumbs up. Don't forget to subscribe down below. Click the bell. Every time I post a video, you'll be at least alerted. I try to make my titles as clean, as clear, and precise as I can. So when you read the title, you're like, that one sounds interesting. I'll check it out. Or that has no relevance in my life. I don't even want to watch it. Don't watch it. But hope you watched yesterday's video. So Tuesdays, I do my rate updates. I pick a program and then I compare my rates to about 5 to 7 different companies out on the web. Big companies, Rocket Mortgage, Guaranteed Rate, Wells Fargo, Bank of America, Chase, everybody I can find. And if you left a comment or subscribed or shared that video, you'll be eligible for a Pigs Get Fat, Hogs Get Slaughtered t-shirt. So that's it for today, guys. God bless. Take care. Have a great evening. And God willing, I'll see you tomorrow, same time, same place. See you then. Bye-bye.